The first question: how successful are institutional investors and fund managers? So let's talk first about professionals. Driving their sports cars, living in their huge mansions, earning obscene amounts of money, investing your money and your pension funds. Surely with their success and wealth, they must really know what they are doing. Wrong. The most simplistic measure of any investor is that they should be able to beat the market averages that they're investing in. Let's look at the shocking truth. Standard & Poor's actually measure this performance every year to see how well the average funds and fund managers perform against the market averages. This truth is shocking. This information is taken directly from Standard & Poor's websites, and they do a regular quarterly report on this. This table here is from 2010, and it shows the percentage of US equity funds that have been outperformed by the benchmarks. Here we can see clearly the percentage of US equity funds outperformed by the benchmarks. So if I'm an institutional investor, I'm running a large cap fund investing in the S&P 500, then 75% of these funds have been beaten by the benchmark. That means these professional fund managers, professional investors, 75% of them can't even beat the basic stock market that they're investing in. That's an incredible figure. Look at this figure. All mid-cap funds. 80% of those funds were beaten by the stock market itself. Small cap funds, 71%. All multi-cap funds, 65% could not beat the market. It goes on and on. Large cap value funds, 80% again. Large cap core funds, 78%. Do I need to go on? Fact. Most actively managed funds will lose you money compared to the market averages. So the average of this table is, over 1 year, 72% of funds failed to beat the market. Over 3 years, 64% of funds failed to beat the market. And over 5 years, 66% of those funds failed to beat the market. I think you'll agree when I say the odds are very much stacked against you. Even if you find a fund that performs well, they will usually have very high fees for managing your money, meaning the chances of you making any money at all after fees are even more remote. So this leads me on to the next question. How many funds actually survive? And this is an amazing fact. Nearly 30% of managed funds are so badly managed they actually go bankrupt. Don't believe me? Check out this. This is the latest report from Standard & Poor's survivorship and style consistency of US equity funds. Here we see the fund category, the number of funds at the start, an ominous figure, and survivorship. So of all the domestic funds, only 72% survived the 5-year period during which this was measured. Here, all large cap funds, only 68% survived a 5-year period. And mid cap funds, 74%, 73% for small cap funds, all multi-cap funds, 74%. The list goes on. The news does not get any better the further down the list we go. Even real estate funds, only 82% managed to survive. So on average, 72% of all domestic funds in the US managed to survive 5 years. Why do they not perform better? The problem is manyfold. Most institutions earn their money from a percentage of your total investment pot, not from the money they make for you. Motivation is also an issue. Ever heard the term trading other people's money? Some fund managers trade their own account alongside the corporate account. You bet they make better returns on their private accounts. Imagine, I know I'm going to buy 200,000 shares of ABC Corporation as part of the investment fund I'm managing. This will surely move the market price. Before I make this trade, I could buy 5,000 shares in ABC from my private account, then buy with the institution's money the 200,000 shares. The market price moves up, I sell my private shares for a profit. Easy.